All right, let's talk about the grand finale of the accounting cycle. You know, at the end of every period, there's this one huge, super important step every business has to take. It's called closing the books. And really, it's all about wiping the slate clean for a fresh start.
But how in the world does that actually work? I mean, think about it. A business is making money, spending money all year long. How does it just, poof, hit some kind of reset button on January 1st? How do you make sure last year's wins and losses don't get mixed up with this year's? Well, that's exactly the puzzle we're going to solve today.
You know, the main reason is actually pretty simple. If you want to truly measure how you did for a specific time frame, like a single year, you've got to start fresh. There's no other way. It's all about drawing that line in the sand.
I mean, it just makes sense, doesn't it? The sales you made last December, they shouldn't count towards this January's numbers. You want to know how the business performed this year, period, not this year combined with everything that came before. And to pull that off, you need a system.
And that system? It's built on this really clever idea. And the idea is this: not all accounts are the same. We split them into two basic types: permanent and temporary. And believe it or not, that one little difference, that's the secret sauce that makes the whole reset thing possible. Okay, so here's the breakdown. On one side, you've got your permanent accounts. These are like the business's long-term memory. They tell the ongoing story. Think about your cash, your equipment. Their balances just roll over from year to year. But then you have the temporary accounts. These are more like a single chapter in the book. They only tell the story of this period. We're talking about revenues, expenses, and the owner's drawings, the cash the owner pulls out for personal stuff. At the end of the year, these are the accounts that get wiped clean, reset to zero so you can start a new chapter. This might sound a little abstract, but I bet you've already seen this exact idea in real life, maybe without even realizing it. The perfect analogy? It's right there on your pay stub. Seriously, it's the exact same concept. Just look at that year-to-date column. All year long, it adds up your pay, your taxes, everything. It keeps a running total. But what happens on your first paycheck of the new year? That year-to-date number is back at zero, right? It's a clean slate. Well, that's exactly how your revenue and expense accounts work in a business. Okay, so we know we need to zero out those temporary accounts. But how do we actually do it? It's not magic. It's a really straightforward two-step closing process. This is the nuts and bolts, the procedure for taking that one-year story and carving it into the permanent history of the company. It's literally just two steps. That's it. First, you take all your revenues and all your expenses for the year, and you sweep their balances into the owner's capital account. That one move basically calculates your profit or loss and puts it away. Then, step two, you take the owner's drawings, all that personal cash they took out, and you move that into the capital account too. And this is a great way to picture that first step. Think of it like a funnel. All the revenues flow in from one side, all the expenses flow in from the other, and they meet in the middle in the owner's capital account. The final number, what's left over, your profit or loss, gets permanently baked into the owner's stake in the business. And just like that, the story of the year is locked in. All right, enough with the theory. Theory's one thing, but seeing it with real numbers makes all the difference. So let's walk through an actual example with a company called Net Solutions. We're going to watch them close their books, step by step. First things first, let's look at the money that came in the door. For Net Solutions, they brought in a total of $16,960 in revenues. That's our starting point. Okay, now for the other side of the coin. What did it cost them to make that money? You add up all their expenses, wages, supplies, the whole shebang, and that came to $9,855. So what's the final score? Simple math, right? You take the revenues, subtract the expenses, and bam! The net income for the year is $7,105. This is the number that tells the story of their performance, and this is the number we need to move. Okay, don't let the tables scare you. This is just the official paperwork, the journal entries that make it all happen. See that first block? We're debiting the revenue accounts to zero them out, and crediting the expense accounts to zero them out. And the difference, that $7,105 in profit, gets credited right into the owner's capital. It's a permanent record now. Then in the second entry, we do the exact same thing with the $4,000 the owner took out. Move it from the drawing account to the capital account. That's it. 2 clean entries. So after all that debiting and crediting, what's the point? Why does any of this matter? The payoff? The whole reason we do this is that you get a perfectly, beautifully clean slate. This right here just says it all. On the before side, you've got a busy ledger full of all the ups and downs of the past year. But on the after side, look at that. All those temporary accounts, revenue, expenses, drawings, they're all back to zero. They're empty. And that owner's capital account, it's now been updated. It holds the final score of the past year.
And just like that, the accounting cycle is done. The books are officially closed, the ledger is spotless, everything's in balance, and the business is ready to roll. It can start tracking the new year's performance without any baggage from the last.
So the next time you hear about a business closing its books, you'll know exactly what's going on. It's not just about shuffling numbers around. It's about taking 365 days of work, of wins and losses, and turning it into one single line that becomes a permanent part of the company's story. So it makes you wonder, doesn't it? When your books are closed, what story does your bottom line tell about the last 365 days?